Price of new cars has hit a milestone.
What's driving car prices higher?
What are you hearing from consumers when they come in here?
Prices too high. Car prices seem to have been rising ever since COVID, and there's no turning back on that.
$80,000 trucks are selling for $22,000. Not flood damaged, not salvage titles, not sketchy auction finds. Perfectly functional, lightly used pickup trucks, some with fewer than 30,000 miles, sitting on dealer lots right now, priced at levels that would have seemed absurd just 2 years ago. This isn't a regional blip or a one-brand anomaly. It is a market-wide correction of historic proportions, and the numbers behind it are brutal enough that some industry insiders are quietly calling it the beginning of the end for the American truck market as we've known it. To understand what's happening today, you have to go back to 2022, because that's when the fuse was lit. The peak that set up the crash. In early 2022, the average transaction price for a new full-size pickup truck crossed $61,000 for the first time in history. Used trucks were selling at auction for 110% to 125% of their original MSRP, meaning buyers were paying more for a 2-year-old truck than the factory had originally charged for it new. That had never happened before, not once in the American auto market. A fully loaded Ford F-150 Platinum with a $68,000 sticker was routinely clearing $80,000, $85,000, sometimes $90,000. Dealers were tacking on $10,000 to $15,000 market adjustment fees, and buyers were paying them because inventory was razor thin, demand was relentless, and anyone who needed a truck was playing entirely by the dealer's rules. This wasn't driven by the trucks getting better. It was driven by a supply chain that had been deliberately choked. When the pandemic disrupted manufacturing in 2020, automakers made a calculated decision: cut production, protect margins, and prioritize high-profit vehicles, trucks and SUVs, over lower-margin sedans and economy cars. The strategy worked spectacularly in the short term. Ford posted its highest per-vehicle profit ever in 2021 and 2022. So did GM. So did Stellantis. Executives were celebrated. Bonuses were paid. But that same decision also compressed 2 years of consumer demand into a single buying window. And when inventory finally began flowing again, the market didn't normalize. It detonated. Buyers who had spent months waiting pounced the moment trucks appeared on lots. Dealers who had watched customers beg to pay over sticker had no incentive to return to MSRP. And buyers, convinced that supply shortages could return at any moment, signed whatever the finance office put in front of them. The loan that became a trap. Every truck sold at those inflated prices came attached to a loan. And those loans were structured on an assumption that quietly became fiction, that the truck would hold its value. When production normalized and inventory filled back up, that assumption collapsed. Trade-in values cratered. Interest rates climbed from near zero in 2021 to 7% and 8% by late 2023, making the monthly payment on a replacement vehicle unmanageable for most families. Buyers who had overpaid were suddenly stranded, unable to trade in without absorbing a massive loss, unable to sell privately at a price that covered what they owed, and unable to refinance their way out because the loan balance exceeded the truck's actual worth. Black Book, which tracks wholesale vehicle values in real time, reported that used full-size truck values have dropped an average of 34% from their 2022 peak. That is not a rounding error. That is 1/3 of the value, gone. Put it in concrete terms. A 2021 Ram 1500 Bighorn that sold for $58,000 in early 2022 was fetching $63,000 at auction just 6 months later. That same truck today, 3 years older, with 40,000 to 50,000 miles on it, sells at wholesale for $26,000 to $29,000. Retail dealers are pricing them in the low to mid-30s, and they're still sitting. For anyone who financed at the peak, the math is punishing. A 72-month loan on a $65,000 truck taken out in 2022 carries a current balance of roughly $45,000 to $52,000, depending on down payment and interest rate. The truck is worth $28,000 at trade-in. That's an equity gap of $17,000 to $24,000, underwater by the cost of an entire used car. Hundreds of thousands of Americans are sitting in exactly this position right now, and it is not being talked about loudly enough. When the lots started filling up, Ford, GM, and Stellantis kept building through 2023 and into 2024. The factories that had been throttled during the pandemic returned to full capacity, but the buyers who had been fighting over scarce inventory were now trapped in loans they couldn't escape. Demand didn't keep pace with production. The lots filled up. By the end of 2024, average dealer inventory day supply for full-size trucks climbed above 90 days. Before the pandemic, 60 days was considered a healthy baseline. Anything above 90 means trucks are sitting, and sitting trucks cost money. Dealers pay floor plan interest on every unsold unit, roughly $10 to $15 per day per vehicle. A dealership carrying 200 trucks for 90 days absorbs $270,000 in financing costs before selling a single vehicle. That pressure forced a response. Dealers started cutting prices aggressively and persistently. Walk onto a Ram dealership in the Sunbelt today, and you'll find 2023 Ram 1500 Tradesman and Bighorn models with $54,000 stickers selling for $29,000 to $32,000. After incentives, factory cash, and dealer markdowns. In Texas, Florida, and across the Southeast, Chevy Silverado dealers have stacked Conquest Cash programs of $8,000 to $12,000 on top of existing manufacturer incentives, pushing combined discounts past $20,000 off MSRP in some cases. Ford has extended employee pricing style deals to all retail buyers, translating to $9,000 to $11,000 off a loaded F-150 Lariat, with additional savings available through Conquest Cash programs. The fire sale is real, and it was entirely preventable. The manufacturers took record profits when prices were artificial. The factories kept running when the market was already softening. The dealers signed buyers to loans that only made sense if values stayed elevated. And when the math stopped working, the pain didn't flow back to the boardroom. It flowed to the buyers sitting in trucks worth half of what they owe. That's the structural story behind the collapse. In Section 2, we'll get into who's taking the biggest hit, by brand, by buyer type, and by loan structure, and what the repossession numbers are starting to look at. Who's paying the price? The price collapse isn't hitting everyone the same way. The damage is concentrated by brand, by loan structure, and by the specific window in which someone bought. Understanding where the pain is sharpest is the difference between making an informed decision and inheriting someone else's problem. The repossession surge nobody is talking about. While trucks pile up on dealer lots, a quieter crisis is spreading through neighborhoods across the country. Federal Reserve data shows auto loan delinquencies, payments 60 or more days past due, hit their highest level since the 2009 financial crisis in late 2024. Fitch Ratings reported that repossession rates among subprime auto borrowers jumped 31% year over year. Full-size trucks, bought at peak prices on 6-year and 7-year loans, are at the center of it. Consider a scenario playing out thousands of times across the country. A buyer purchases a 2022 F-150 XLT in the spring of 2022 for $59,500, $8,000 above sticker, because it was the only available unit in the configuration he needed. and the dealer assured him inventory wasn't coming back for months. He finances $55,000 at 6.4% APR over 84 months. Monthly payment, $826. It was a stretch, but manageable as long as work stayed steady. By late 2024, work slows. He tries to trade the truck in. The dealer offers $27,000. He owes $44,000. He can't sell it privately at a price that covers the loan. He can't refinance because the truck is worth less than the balance. He can't afford the payments without the income to back them. 6 months later, the truck is repossessed. His credit is in ruins. And the truck, now added to the dealer's already swollen used inventory, gets wholesaled at a loss, pushing prices down further for every comparable unit in the market. That cycle is self-reinforcing, and it's accelerating. Every repossession adds supply. More supply drives prices lower. Lower prices push more buyers deeper underwater. More buyers default. More trucks get repossessed. The people who engineered the conditions that created this, the manufacturers who inflated production, the dealers who charged above sticker, the lenders who approved the loans, have already cashed their checks. The buyers are the ones absorbing the correction. The brands taking the hard hits. Not all trucks are depreciating at the same rate. The pattern of which brands are falling fastest, and why, tells a story that every buyer in this market needs to understand. Ram is taking the heaviest valuation losses in 2025, and the reasons are stacking up. Parent company Stellantis has been in visible financial distress, cutting production, closing plants, and managing quality complaints across multiple brands simultaneously. The 2023 and 2024 Ram 1500 EcoDiesel faced a recall affecting 149,000 trucks over a potential fuel leak and fire risk. That kind of headline doesn't stay in the trade press. It circulates among buyers and suppresses resale demand. But Ram's deeper problem is simpler than any single recall. Stellantis pushed more trucks into dealer inventory in 2023 than the market could absorb, then abruptly reversed course with steep production cuts in 2024. The whiplash left dealers holding mismatched inventory at exactly the wrong moment. Ram trucks are now among the most heavily discounted units in the market, and they're declining fastest at wholesale auction. Chevy Silverado is dealing with a different kind of damage, and in some ways, a more insidious one. GM's cylinder deactivation system, a fuel economy feature that shuts down engine cylinders at highway speeds, has generated a wave of expensive lifter failures in millions of 5.3-liter V8 engines. Class action lawsuits are active. Out-of-warranty repair costs run $2,000 to $7,000, depending on the severity. Buyers who know about it are actively avoiding used Silverados from model years where the system was active. Buyers who don't know about it are purchasing a mechanical time bomb at retail prices. The secondary effect on resale values is real and ongoing. Informed buyers are discounting their offers, and uninformed buyers are eventually going to discover the problem after purchase. Ford's F-150 is holding its value better than either of its main competitors, but it is not immune to the broader market correction, and it carries its own cost traps. The aluminum body Ford introduced in 2015 is genuinely durable, but collision repair costs are significantly higher than on steel-bodied competitors. A fender bender that costs $800 to repair on a Silverado can cost $3,200 or more on an F-150. Insurance adjusters know this, and total loss thresholds hit faster on aluminum-bodied trucks, which creates a structural drag on resale values. Complexity in modern F-150 powertrains, particularly the 10-speed automatic transmission, has also produced a steady stream of reliability complaints that serious used buyers are starting to price in. What dealers know that they won't tell you. Walk onto a dealership lot today, and you're entering a business under serious financial pressure. even if everything looks polished and upbeat. Average per unit profit on new truck sales has collapsed from roughly $4,500 at the peak in 2022 to somewhere between $500 and $800 today. Some volume dealers are accepting losses on individual units just to clear inventory and reduce floor plan costs. The business model that made truck sales extraordinarily profitable 3 years ago has inverted. But here's what no salesperson is going to volunteer while you're reviewing figures in the finance office. The truck you're buying today may be worth 20% less within 12 months. Not because it's a bad truck, because the market is still correcting from the most overheated pricing environment in automotive history, and according to analysts at Cox Automotive, it hasn't finished. Manheim, the country's largest wholesale auto auction, reported month-over-month declines in full-size truck values for 11 consecutive months heading into spring 2025. Cox analysts are projecting an additional 8% to 12% drop in used truck wholesale values by year-end. That projection matters in ways buyers tend to underestimate. If you purchase a $42,000 truck today and values fall another 10% over the next year, you've lost $4,200 in equity before your first ownership anniversary. If you borrowed the full purchase price, you're underwater in year 2 before a single unexpected repair, before any change in your financial situation, before any of the variables that make long loan terms genuinely dangerous. Dealers are focused on moving today's inventory. That is their job, and they're good at it. Protecting your balance sheet over the life of a 72 or 84-month loan is not their responsibility. It has to be yours. The hidden cost. Inside the deal. The advertised discounts are real, but the way most buyers actually finance them quietly erases a significant portion of the savings. The headline deals, 0% APR, massive cashback, employee pricing for everyone, are structured to move inventory quickly and make the monthly payment feel manageable at the point of sale. The 0% financing offers are almost universally capped at 36 or 48 months. Extend to 72 or 84 months, which is where the majority of buyers land when the payment needs to fit a budget, and the rate jumps to 6.9% to 8.4%. On a $42,000 truck, financed over 84 months at 7.9%, the total interest paid over the life of the loan exceeds $16,000. The $8,000 discount on the sticker price just got cut in half, quietly, in the finance office, while you were focused on the monthly number. The discount is real. The math behind it is more complicated than it looks on the showroom floor. The buyers who are coming out ahead in this market are the ones running the full numbers, total cost over the loan term, projected resale value at trade-in, and the gap between what they'll owe and what the truck will be worth at the 2 to 3 year mark. That calculation is not one most dealerships are going to walk you through. In Section 3, we'll cover exactly what smart buyers and current owners should be doing right now, whether you're in the market to buy, trapped in an underwater loan, or trying to figure out your next move before the market falls further. What you should do right now. The collapse of the truck market is painful for the people caught in it, and genuinely opportune for the people positioned to take advantage of it. Which side of that line you land on depends almost entirely on preparation. Here is what each type of person in this market should be doing right now. If you're thinking about buying for cash, buyers and buyers with strong credit who aren't locked into a current vehicle, this is one of the best windows to purchase a used truck in the last decade. A 2022 F-150 XLT with 45,000 miles that originally sold for $58,000 is now sitting at $34,000 to $37,000 at retail. That is genuine value on a truck with significant useful life remaining, if you buy it correctly. The opportunity is real, but so are the landmines. Here's how to navigate both. Know the wholesale price before you walk in. Black Book and Manheim publish current wholesale averages by model, year, trim, and mileage. These numbers are accessible and free. If a dealer is pricing a used truck $8,000 above current wholesale, you have leverage. Use it. A dealer carrying floor plan costs on aging inventory has a strong incentive to negotiate. You have more room than the sticker suggests. Get an independent pre-purchase inspection. On any used truck priced above $20,000, this is non-negotiable. Not the dealer's service department. An independent mechanic with no relationship to the sale. Budget $150 to $200 for the inspection. It is the cheapest insurance you will buy in the entire transaction. A single undisclosed issue, a transmission with early wear, a frame with hidden rust, a suspension component approaching failure, can easily cost more than the inspection would have. Check the VIN before you commit to anything. The NHTSA database at nhtsa.gov allows a free recall lookup by VIN in under 2 minutes. Open recalls are the seller's legal obligation to disclose, but not every seller does, and not every buyer asks. Do not skip this step on any vehicle, regardless of how new or clean it looks. For GM trucks specifically, ask about the 5.3 LV8. Request maintenance records and ask directly whether the truck has ever been to a dealer for engine noise, misfires, or the active fuel management system. If it has appeared more than once for any of those issues, treat it as a disqualifying factor and walk away. The potential repair cost, $2,000 to $7,000 out of warranty, is not a risk worth accepting when comparable alternatives exist. Run the full loan math, not just the monthly payment. Calculate total cost over the entire loan term, including interest. Project the truck's estimated resale value at the 36 and 60-month mark using current depreciation trends. Measure the gap between what you'll owe and what the truck will likely be worth at those points. If you're financing at 7% or above over 72 or 84 months, that gap can be significant, and closing it requires either a meaningful down payment, a shorter loan term, or both. The monthly payment is a marketing number. The total cost is the real one. Be patient. Analysts are projecting continued wholesale value declines of 8% to 12% through the remainder of 2025. If your purchase is not urgent, waiting 6 months could mean a meaningfully better price on the same vehicle. The market is still moving in your direction. If you're already underwater on a truck loan. If you bought during the 2021 to 2023 peak and your loan balance exceeds your truck's current market value, you are not alone, and you are not out of options. But the window for making smart moves narrows the longer you wait. Contact your lender before you miss a payment. This is the most important step, and the one most people avoid until it's too late. Lenders are not indifferent to the current market. A repossession followed by a wholesale sale at $20,000 below loan value is a loss they want to avoid. Many lenders are working proactively with underwater borrowers on payment deferrals, loan modifications, or extended terms, because a negotiated solution is mathematically better for them than a default. Once you've missed payments and the account is in collections, your leverage to negotiate evaporates. Explore refinancing, but verify the numbers first. Some lenders are offering refinancing options on underwater loans. Before pursuing this, confirm the new rate, the new term, and the total interest cost over the life of the refinanced loan. Extending a 72-month loan to 84 months lowers the monthly payment, but increases total interest paid, potentially by thousands. Refinancing can be a useful tool, but only if it actually improves your overall financially position, not just your monthly cash flow. Consider whether selling at a loss now is better than continuing payments. If your truck has depreciated significantly and you're stretching to make payments, selling, even at a loss, and absorbing the difference into a personal loan at a lower interest rate may be a more financially sound path than staying locked in a declining asset loan for another 4 years. Run both scenarios with complete numbers. The emotionally difficult choice is sometimes the mathematically correct one. Do not roll negative equity into a new purchase. This is how the debt spiral compounds. Dealers will often offer to take care of your negative equity by rolling it into a new vehicle loan, which means you start the new loan already underwater, at a higher balance, with more interest accruing from day one. It solves the immediate payment problem and creates a larger one. Avoid it. The bigger picture. The American truck market will find its floor. Values will stabilize. At some point, likely 18 to 36 months from now, inventory will normalize, depreciation will level off, and the extraordinary discounts currently on the table will narrow or disappear. The cycle will eventually turn again, as it always has. But the structural lesson from this collapse is one the market has taught before and will teach again. Asset prices that defy economic gravity long enough eventually correct, and the correction is almost always faster and more painful than anyone modeled. The people who paid $85,000 for a truck in 2022 weren't irrational. They were responding to real scarcity with real urgency. The problem wasn't the decision in isolation. It was the loan structure that assumed the asset would hold a value it was never going to hold once the artificial conditions driving it disappeared. The manufacturers captured the upside. The lenders charged for the risk. The dealers collected the margin. And when the math stopped working, the loss landed on the buyer sitting in the driveway, looking at a truck worth half of what the paperwork says. That is the receipt for how this market operated for 3 years. The buyers who come out ahead from here are the ones who read it clearly and refuse to sign a version of the same agreement again.